Introduction. Capital budgeting is the process through which firms evaluate and select long-term investment projects that are expected to generate returns over multiple years. These projects may involve purchasing new equipment, launching new products, acquiring another company, or expanding operations. Effective capital budgeting ensures that firms allocate scarce resources to investments that maximize shareholder value. Importance of capital budgeting. Capital expenditures typically require substantial financial commitments and have long-term implications. Poor decisions can result in significant financial losses, while effective decisions drive growth and competitive advantage. Therefore, capital budgeting is a critical function of the financial manager. Types of investment projects. Replacement projects. Replacing old assets with new ones to maintain operations. Expansion projects. Increasing capacity or entering new markets. New product development. Investing in research, development, and launching new products. Regulatory compliance. Investments needed to comply with regulations. Cash flow estimation for capital budgeting. The foundation of capital budgeting decisions is the estimation of relevant incremental cash flows, initial investment, purchase price, installation costs, and working capital required. Operating cash flows, additional revenues minus additional operating expenses. Terminal cash flows, salvage value, recovery of working capital at the end of the project. Only incremental cash flows that differ due to the project should be considered. Investment decision rules. Several techniques help evaluate projects, weighing costs and benefits over time. Net present value, NPV. NPV is the sum of the present values of all expected cash inflows and outflows, using the firm's cost of capital as the discount rate. NPV equals the sum from T equals 0 to N of CFT, divided by 1 plus R to the T power. Decision rule. Accept projects with NPV greater than 0. NPV directly measures the value added to shareholders. Internal rate of return, IRR. IRR is the discount rate that makes the NPV equal to 0. Decision rule. Accept if IRR greater than required rate of return. IRR provides a percentage return metric but can be misleading if projects have non-conventional cash flows or multiple IRRs. Payback period. The payback period is the time needed to recover the initial investment from project cash inflows. Decision rule. Accept if payback period is less than a pre-specified limit. While simple, it ignores the time value of money and cash flows after payback. Discounted payback period. Similar to payback but discounts cash flows. Decision rule. Accept if discounted payback period is less than the project's useful life. Addresses the time value of money limitation, profitability. Index PI. PI is the ratio of the present value of future cash inflows to the initial investment. PI equals PV of future cash flows. Initial investment. PI equals the fraction PV of future cash flows over initial investment. Decision rule. Except if PI greater than 1. PI greater than 1 for ranking projects when capital is rationed. Capital rationing. When firms have limited funds, they must select projects that maximize value within budget constraints. This requires ranking projects by profitability index or other criteria. Real options in capital budgeting. Real options give firms flexibility to adapt decisions based on future market developments. Expansion option. Invest more if project succeeds. Abandonment option. Exit project to limit losses. Timing option. Delay investment until uncertainty reduces. Recognizing and valuing these options can increase project valuation. Risk analysis in capital budgeting. Since forecasts are uncertain, assessing risk is vital. Sensitivity analysis. Examining how NPV changes with key variables. Scenario analysis. Evaluating best, worst, and base cases. Monte Carlo. Simulation. Using probability distributions to model uncertainty. Summary. Capital budgeting is a core corporate finance activity involving identifying, evaluating, and selecting long-term investment projects. Understanding cash flow estimation and applying rigorous decision rules like NPV and IRR ensures efficient capital allocation and maximization of shareholder wealth.